Hey guys, this is Toby Mathis.
Jeff Webb.
And you're listening to Tax Tuesday. This is a special, let's see if I can make it do its thing. This is me working with technology. This is a Super Tax Tuesday for Super Tuesday. If you don't know what that means, you've been living under a rock. All right, so we're just going to jump right on in. It's another, I have like a lot of questions today, so we want to make sure that we're getting it. The first thing you should do is always make sure that you're engaging with us on social media if you like this type of content, and if you want to get your questions answered, there's nothing better. As we're going through Tax Tuesday, ask live and we will answer before the end of the webinar. I already see there's some questions coming in. Send in questions at Tax Tuesday to Anderson Advisors. That's where we pick the questions for every Tax Tuesday. Just to give you an idea, we have about, usually in every Tax Tuesday, there's about 200 questions. And then we get a ton that get emailed in. If you need a detailed response that's specifically to you guys or to your situation, you probably need to be a Platinum or tax client. You could always try to ask it, but again, if it's too deep, it's probably not something we're going to dive into on this. It's fast, fun, and educational. We want to get back and help educate. Let's go over some of the questions we're going to go over today. We already have some stuff here. We have rules now. Yes, we have rules. Aloha, Mark, and I'll answer some of the questions that have already been up there. Here's an easy one. First question, that's not even a standard question. Somebody asked online is how to assign an LLC tax as an S Corp to your living trust. It's really easy. You actually just do a simple assignment. I actually use a one-page assignment for all of my entities that are going to be held by a living trust, and it goes from your name individually to your name as trustee of your living trust, and there's no tax hit. Here we go. Let's just start diving into some questions. And somebody says, if a C Corp, well, I will answer some of these questions that are coming in a little bit. And we got some more people from Hawaii out there. So, hey guys. First question we're going to be answering tonight is, I'm looking to enter the short-term rental industry through rental arbitrage. Sounds like they're going to do Airbnb. If I were to put my Alabama LLC inside my trust, is the income distribution protected against a lien? Should I add another layer by creating a Wyoming LLC as a single member of the Alabama LLC? So we'll go over that. Is there a tax rules? Somehow I managed to somehow sneak through here once in a while. Are there tax rules that allow a farmer to accelerate depreciation for farm equipment? How do you keep track of your reimbursable expenses before your corporation makes a profit? And what tax rate do I have to pay on early withdrawal from my IRA? And again, we grab these straight off of the, we create a little spreadsheet of these. So sometimes I clean them up, but for the most part, they're as people ask them. I moved my home and business that I run from my home from Illinois to Florida in June 2019. Can I deduct my moving expenses? How do capital accounts get handled in trust? Specifically, do they stay with the trust when the beneficial interest is sold? How can we write off tuition for our training? My sister and I are partners in our LLC. She's now on disability. Excuse me. This looks like it's two questions. How can I write off tuition for my training? And then my sister and I are partners in our LLC. She is now on disability. How can she receive profit from the business now? I have a feeling those are actually two questions, but I'll answer them both. I've heard it's not worth taking the bonus to, it's actually depreciation unless you plan to purchase yearly. Is it worth doing a cost segregation for $141,000 property that rents for $1,250 per month and taking bonus depreciation? So I'll answer that. What is the proper way to account for expenditures made to improve a warehouse building? Should expenses above a certain amount be capitalized versus expense? Does it depend on the nature of the expense, like HVAC, flooring, lighting, etc.? You guys are asking some pretty good. Then let's go. I'm looking at selling a car wash I own and doing a 1031 exchange, and have a few questions. Can I roll the money into a real estate fund like an opportunity zone fund, or does it have to be a hard asset? If I roll the money into an apartment building in an opportunity zone, which I sell after more than 10 years, what is my basis for sale? Is it the same basis if I donate property to a nonprofit instead of selling it? So interesting questions. The reason I grabbed this one is because it's a three-parter, and usually I would say, no, let's not dive into all of these. but it's covering actually about 3 different issues that I wanted to hit on. We are thinking to sell our owner-occupied property to a C Corp. We'll set up by my husband using a contract for deed to get $500,000 of capital gain tax-free. How I structure the TAN plan, how should I structure the tax plan to get the max tax savings benefits? I'm president of a C Corp. Can I deduct long-term care premium for me and officers of the corporation? So we'll dive into all this. We purchased a house in 2019 and lived in it for 3 months. After moving out in July, the house was available to rent. We then decided to undertake a major renovation addition without renting it out. Although all the expenses need to be added to push up the basis, can we do a cost segregation to push our income down? Interesting question, and I'm sure that Jeff's going to want to weigh in on that one. As a new C Corp in which I'm the sole officer, if I cannot afford to pay a reasonable salary, can I submit items to the C Corp for reimbursement? If I do, would it raise a red flag with the IRS since I'm drawing compensation in an indirect way? Interesting question. Do you have to use the accrual method for books when you start dealing with loans for the company? Is there an advantage or disadvantage to using cash or accrual accounting? Jeff, that sounds another one like you. If my corporation has a promissory note to myself, but the interest is less than $600, do I have to give myself a 1099? I still claim the interest on my personal taxes, correct? If someone is in a memory care facility locked down 24/7, is that tax deductible? So we're going to go through all of these. Somebody said, hey, why do you always read all the questions? And it just makes it go cool. Because we're looking at where we're headed. So the only reason I read these out, David, is because I want to make sure people see what questions we're going to be answering, and they may stick on to hear a certain question as opposed to just sitting back. So that's the only reason. Other fun stuff, and this is kind of serious, and this has you've heard me say this before. We have a bit of an issue, and it's not the coronavirus. The big issue that we have is we have massive amounts of suicide going on with our service members, and our mental health facilities. God bless them, but they're insufficient for what's going on. And so we as people have to decide whether it's important to us. There's over 600 service members a month who are taking their own lives after going out and defending our country. If you know anybody that's in that situation, please give them this information. You can text, you can call, there's chat online. There's all sorts of services that are available to them. And the thing is they probably will not do it themselves. You also know that I'm a big believer in One Veteran Foundation. It's a company that we worked with. And they do a great job of matching veterans who have PTSD with service animals. And they get it done for a fraction of the cost of what these things are out there. So if you want to support them, please do oneveteranfoundation.org. Interesting note, the last time I did this, somebody called me up and said that they, the following week said that week, one of their friends took their own life who had come back, and part of it in that moment of, feeling horrific, they decided that they wanted to do something to change it. I've had that conversation with so many people. So please, I know we're talking taxes, but please think about doing some things to help our service members. All right. First one, I'm looking to enter into short-term rental industry through rental arbitrage. That's Airbnb. That's somebody who rents a property long or buys a property and then leases it short. So I get a house on a monthly basis, and when I hear arbitrage, I'm thinking that they're probably renting it. So I rent it for $2,000, and then I rent it to other people for $200 a night or something like that. And the big question is, if I were to put my Alabama LLC inside my trust, is the income distribution protected against a lien? Should I add another layer by creating a Wyoming LLC as a single member of the Alabama LLC? So let's kind of unpack this real quick. And sorry, I'm going to have to jump on this one because it seems to be, it's more along the asset protection side. So the first one is, so if you are the property owner, you're always going to have a certain amount of liability just by owning that property. And our recommendation is if you're doing short-term rentals, which is 7 days or less, it's going to be considered active income. And so if it's active income, you want to make sure that it would be taxed with Social Security tax. So we want to avoid having it all the money being treated as active income. So we would have the real estate separate from the host. And when you do these short-term rentals, I'm just going to use the terminology. You have guests, you have hosts, you have landowner, all this fun stuff. And so you as a landowner, you put it into an LLC and it leases it to the host. And the host is generally going to be an LLC taxed as a corporation or a corporation proper. And that's who's dealing with all the guests. Now, this is why it's important, because the guest, if they have an issue, the question is, who are they going to sue and what is the issue? What are their rights? So let's say it's discrimination. They're probably not going to get to go after the landowner. They're going to be stuck with the host. But let's say that they fall down the stairs and they say the landowner was negligent. They're suing the host and they're going to try to go after the landowner. And that's called inside liability. That's the liability you have just because you own something or because you're conducting a certain type of activity. So then we look and say, all right, now if it's making money, can they attach that money? So you're saying here's a lien. So the question always becomes, who do they have a lien against? And what does that particular entity make? So for example, if we have a host who is renting from the landlord and that rent is $2,000 a month and they get something against the landlord, they may be in line to try to grab some of that $2,000 a month. That's going to be their win, or they're going to try to get to the actual piece of the real estate. If it's a lien against the host, well, that's easy because the landlord just boots the host and now they have nothing they can get. You're not going to keep making money if all they're going to do is take it. Now, when we bring in the Wyoming LLC, that doesn't help you at all for inside liability. Where a Wyoming LLC comes in is if somebody's trying to take your assets, including your interest in this business, this arbitrage business. If they want to take that, we can make it to where they can't take it. And all we're doing is saying, hey, we have a Wyoming LLC. Under Wyoming statutes, the most they could ever get is a lien against that LLC. So if that LLC owns an interest in an LLC that runs a Airbnb, or it owns an interest in an LLC that owns some other real estate or other businesses, the most they could ever get, they can't take your interest away. The most they could ever get is a lien against that. And as a result, most people don't, because it's really expensive to go get a judgment against somebody and attach it against an LLC. So that's what it really comes down to. So there's actually three pieces here. There's the landowner, there's the host, and then there's the individual owner of the LLCs. And we want to create separation from all of them. So I know I gave you a little bit of a convoluted answer. It depends on your circumstances. But quite often in this type of business, you're going to have the host be its own entity. And if you are renting, that's all you need to do is have that host entity. And if you're worried about the host entity, it has a whole bunch of properties that it's doing this with, and you're worried about the host entity, by all means, put that into a Wyoming LLC so nobody can take it away from you. So, yeah, somebody says it depends. That's always the answer. It's facts and circumstances, right? Mm-hmm. It's what's best for you. There's no such thing as cookie cutter. All right. Is there a tax rules? I just love that type of stuff. Is there tax rules?
I think my mom from Kentucky sent this one in.
Yeah. So, and I thought I actually fixed, are there tax rules that allow farmers to accelerate depreciation for farm equipment? So, before anybody sends me any hate mail, my dad was from Mobile, Alabama, and all my relatives. So when I do that, my brother's in Slidell, Louisiana. So it's like, I'm just brazen. I would give him the same ribbon.
Yeah. I mean, farmers are allowed to take Section 179. They're allowed to take bonus depreciation. Mm-hmm. The only rule that kind of counters this is that farmers have a slower recovery period.
Got moved to 5 years.
They did move it from 7 to 5 years on new farm equipment starting in 18.
But before that, it was what, 150%?
It was still 150%. So it's a little slower, but you still get it all over time.
So what Jeff is basically saying is there are two exceptions to the general rule. So like if you buy equipment now, it's 5-year property. Mm-hmm. If it's 5-year property and it's equipment, you could elect to treat it as 179, which allows you to write off up to $1 million. It's indexed for inflation, so I don't know what it is this year. but it's like $1 million immediate deduction. If it goes over $2.5 million of equipment, then you're phased out. I believe it phases out. Then the other rule is that you have bonus depreciation. So this begs the question is, why would you ever do 179 when you could bonus depreciate? Bonus depreciation allows you to take anything that's less than 20-year property and write it off. So if you are a farmer and you want to accelerate the depreciation for farm equipment, you could write off 100% in year one, even if you financed it, even if you haven't paid it all off.
Now, if you build a barn or any kind of outbuilding, it's going to be a 20-year life, which is shorter than the other building.
That's not going to be eligible for bonus.
It's not going to be eligible.
Right. So you're going to write off. But what you can do on those, too, is cost segregate it and take it into its pieces. A lot of questions are coming in. This is kind of fun, which I'll get to them. I'll get to them in a second here. All right. How do I keep track of reimbursable expenses before the corporation makes a profit? This is right up your alley.
Well, yeah. As you're going along, you want to make sure that the corporation is reimbursing you for all your expenses. You don't want to save them up and reimburse them down the line. But what's going to happen is you're going to take those expenses at the corporate level
as a loss, right?
As a loss, and even though doesn't have the money to pay you the cash, it can pay you in the form of a shareholder loan. So you're still being reimbursed for it, and eventually, hopefully, you're going to do well, and you're going to get reimbursed for that amount that you've loaned the company through these expenses. Yeah.
So how do you keep track of it? Just like you would any other expense. Can it reimburse you? Not unless you give it the money to reimburse you. So it's either going to be an IOU or like a loan to the company, or it's going to be contribution to the company. It's going to be one or the other.
And we've actually had people ask, should I loan the company money so I can repay
myself?
And it really doesn't work.
You just do it as a contribution, or you just wait for it to make money? You just sit there and it owes you the money, and you're waiting for it to make some money. So you just track it. You just have to keep a written record of it. Somebody asked, can you take 179 if you don't have enough profit? Meaning you can't create a loss with 179. Right. So your 179 cannot create a loss, but it can take you to zero. A bonus depreciation can give you a loss. So this is kind of interesting. Oh, somebody asked a really weird one. Can you discuss the IRS safe harbor rule for claiming loss from a Ponzi scam? What is needed to validate a claim? This is crypto platform related.
Unfortunately, in 2018, the casualty losses for Ponzi schemes went away.
Yeah.
The only casualty loss left is for presidential disaster areas.
But if you were a victim of a Ponzi, you would still get a capital loss. So you don't lose it all. You just carry it forward,
no, you
right?
don't. You don't get it. We ran into this with somebody had their Bitcoin wallet stolen.
Oh my God. And they don't even get to write it off as a loss?
No, because it's considered a theft loss, not an investment loss.
And you don't get to take that at all?
No.
Something new every day. That's crazy.
That is crazy. I don't agree with it, but that's what our research has found.
Yeah. Well, hey, Gary, shoot in an email with that too. We can dig into it. And I don't doubt that Jeff is correct, because I remember seeing something about somebody.
I would certainly like to be wrong.
You know what it was? You're right, but it was out of a business, and they were able to write it off as a business theft.
Yes.
So if it's you individually, you may be out of luck. If it's you as a business, you might be okay.
Yeah.
So if it was Bitcoin purchased through a business, but I want to see that, and that's something that it may be ripe for a little discussion with the IRS, because I'm sure that they're not wanting to have inequitable solutions, but that's just crazy. I remember that the rules went away, and so all these folks, it would be like the Bernie Madoff folks. They don't get to write it off if it was stolen. Can you take bonus depreciation on equipment? Yes. So bonus depreciation is available for anything under a 20-year life. So the way the IRS treats it is anything you buy, anything that's that's acquired on a building or anything like that. If it's personal property, it has a useful life. If it's structural property, it has a useful life. Everything has a useful life to the IRS. And they assign it. So they'll say, hey, everything flows into this, and if it's under a category that is less than 20 years, you can bonus depreciate it under 168K. So that's 26 USC 168K. All right, so we already answered this one. There's lots of questions online. I may pick one here. If a C Corp needs to be folded, how does one handle a 401k sponsored by the corporation? So corporation goes under, does the 401k go under?
No, it does not. It is separated from the corporation.
Yeah, it loses its sponsor, but it's still there. So you could still run it, or more than likely someone's going to roll that into an IRA or into another 401k.
Right. There's actually a federal government agency. I can't remember the name of it right now, but their whole goal, the Pension Guarantee Benefits Corporation.
Yep.
Whose whole purpose in life is to support pension funds once their sponsor has gone belly up.
Someone says, forget Debbie Downer, it's now Toby Downer. You guys are just mean. Probably because of this. I'm going to keep chipping at you guys on this service member stuff. I just think it's horrible that we're just such a great country and we can't seem to get our mental health stuff going. And that's what's fueling a lot of issues. That's fueling a lot of homelessness and everything else. I worked in that field a little bit. I've had some personal experience with a lot of people that I know, and it's not a great system right now. It's really overloaded and difficult. So anyway, so I'm just going to gripe about it a lot. Let's see. What did somebody says? Is selling an owner-occupied duplex? How do I 121 and 1031 exchange? I'm getting different answers. That's a really good question. So basically, you have a duplex, and the way it works is the property is treated as two different properties.
Correct. You split that property in half.
You split it in half, right? So you're going to do your 121, Section 121 on half of the income, assuming that they're about the same size. If they're different, then your appraisal would break them out.
Correct.
And you get your 121 exclusion, which is the capital gains exclusion, and you would 1031 exchange the rest. And that's going to take a very good facilitator, since it's actually not the entire property. All they have to do is do the paperwork saying, here's the portion that that's 1031.
It's always a good idea to ask your qualified intermediary some questions and see if they get that glazed look in their eyes.
You just ask them. I know some good ones if you need them. Let's see. What tax rate do I have to pay on an early withdrawal from my IRA?
It will be at your marginal tax rate. So if you're making, say, $80,000 a year, you're probably in the 22% bracket. So you're going to pay a rate of tax about 22%. The other side of that is if it's an early withdrawal without any kind of exception, there's a bunch of different ones for first-time home buyer and medical expenses. You're also going to pay a 10% penalty on that early withdrawal. So it could be quite expensive.
It can be very expensive. And so here's the general rule. It's the Jeff Hayes, it stinks rule. You're going to get hit with 10% early withdrawal and your income tax. And then there's the exceptions. And the exceptions are if you're over 59 and a half.
Yeah, if you're over 59 and a half, it's not considered an early withdrawal.
Then you don't have the 10%. You're still going to have tax on it.
Right.
And somebody just said to me on that last one that we did something different in Platinum. Patty or somebody grab a hold of that and let's take a look at what was sent in. Not everybody's omnipotent, but that's a fairly straightforward question.
But one of the things we often hear was, well, I took that money out because I had a financial hardship.
That's an exception.
So
there's a whole bunch of exceptions. So you have your first home, you have 59 and a half, you have, if it's a medical expense, then you weren't covered, or you're out of work for a while and you're getting basic insurance, then you can do it. If you're disability, there's a bunch of little ones. Military folks can pull it and avoid the 10%. 72T, which really means I'm going to take, when I hit 55, I think I can do 72T, where I just choose to annuitize it. I'm just going to take a set amount forever.
Oh, okay.
Over a period of 5 years or more. So then I could just do that. So there's a whole bunch of exceptions. And then the other one is, if you really need money, take it out of an IRA, roll it into a 401k and borrow half the money. There, now it's free. You don't have any tax on it. So so the way that works is you roll your IRA, which you can absolutely roll any IRA other than a Roth, which we wouldn't be having this conversation if it was a Roth. If it's a traditional IRA, you roll it into a 401k, and you're allowed to borrow up to half the money, up to $50,000 per participant. So if you have an IRA, your spouse has an IRA, somebody that you know has an IRA, they can roll it into a 401k, and you could borrow half that money, up to $50,000. So husband and wife could borrow up to $100,000. So that's an option as well. And then you don't have to worry. Somebody just says, isn't it better to take a loan out against your retirement account? Did that to invest in tax liens and arbitrage? Yeah, absolutely. Yeah, so it's federal AFR rates, which are around 2% right now, is what you're paying back your own retirement account.
Yeah, you just can't do it against your IRA. You can't use your IRA for borrowing or any type of collateral.
Yeah. Somebody says, hey, do you have someone who will do cost seg in Colorado? Absolutely, Mina. Shoot me or shoot Patty will grab you or Susan will grab your information. Let us know, and we will absolutely get you somebody awesome for Colorado. And anywhere in the country we can get you taken care of. We don't do it, but I have really good people that do, and have done, I don't know if it's hundreds, but dozens of them for sure. Mm-hmm. All right. I've done hundreds of analysis to see whether it works. And then, all right. I moved my home and the business that I run from my home from Illinois to Florida in June. Can I deduct any moving expenses?
Well, with the Tax Cut and Jobs Act, they killed the moving expense completely. Mm-hmm. There is an exception for military.
That's it.
You can deduct the cost of moving the business assets. Mm-hmm. But that's about it. So
that's absolutely the case. What you do is you do your analysis of how much of your home is the business asset. And I would probably be looking at that, saying what percentage of the moving expense would therefore be a reimbursable business expense. Or you could always have somebody give you a quote on moving just the business stuff to Florida.
Right.
Say how much would it be, and then that's the amount that you can reimburse yourself from the business. So the business would take it as an ordinary necessary business expense. There's a whole bunch of questions that have come in, so I'm going to go over a couple of these. If I want to sell my stocks as a person with long-term profit, therefore large taxes, that's not necessarily the case. You could be 0, 15, or 20% on long-term capital gain. And then to invest these monies into my C Corp to buy property and flip, what is the best way to reduce taxes? So Irina, if you're going to sell stock and then you want to reinvest it into something else, you're going to pay the long-term capital gains on the stock. Usually what we're doing is we're looking at loss harvesting if you're going to have gains. So if you have any losers, it's time to sell them and take that loss against your long-term gain. And hopefully that'll offset some of the tax. If you don't have any losers, you've just done really well and you just have a whole bunch of profit, then it's bracket management. Are you in the highest bracket? Are you in the middle brackets? Can we get you down this year? And, let's just say you're in the highest tax brackets. You're looking at 20% or 23.9, depending on if you're over 250,000. And then you have to look at your state. So there's some things you're going to look at, and we're going to say, all right, here's what you're looking at from a tax standpoint. And then is there a way to avoid it? And the answer is, yeah, you can do a qualified opportunity zone. So if you're going to flip, you may want to flip in an opportunity zone through an opportunity zone fund, and then you could defer that tax. Now you're going to defer it 6 years. So I don't want to give you convoluted and crazy stuff. Just saying you have options to defer it for 6 years. You have options of ways to offset it. You have a lot of different options. And so with a little bit of information, we could give you some really good guidance.
And the way the market's been for the past week, this might be a good time to harvest some of those losses, especially if you got gains.
Yeah, if you have gains, and what you do is you sell all the ones that have crapped out here lately.
Yeah, I saw the market was down another 3% today.
Yeah, and here's the deal. You can't buy it back within 30 days.
Right.
You got lost sale rule. So when you have losses and you want to take them, then you just wait to buy it back. So,
and that's a good point, because some people get the gain side confused too.
yeah,
I can sell that, recognize the gain, and go out the next day and buy the
end
property.
of every year. You know what we do this? We sit there and we look at people and we're like, they'll have a loss, and I'm like, and they'll have a bunch of stocks that have run up, and they'll be like, yeah, but I'm going to keep them. I'm like, so sell it and buy it right back, like 10 seconds later. Well, then I won't get to use it. No, yes, you can. There's no wash gain rule. It's only the wash loss. So it's when you sell it and take a loss. So I could, if I have a big loss and I know I can sell something and push the basis up and not pay any tax on it, I'm going to sell it now. All right. Hey, somebody did, let's see, we set up a C Corp, used some individual contractors on a rehab, but didn't get the info required to send them the 1099. What are my options? I found they need to be sent by January 31st. So it sounds like they had some contractors and they didn't 1099 them. So what do we do?
You should contract, or you should file the 1099s even though they're late.
Mm-hmm. What if they're not responding to them and they just say, hey, I'm not going to give you any information? You should have done the W-4.
You should have done the W-9.
W-9 for an individual.
Correct.
Yeah,
before you ever paid them a dime.
Yep.
Even if you don't have their social security number, you still probably have their name and address. IRS still wants those 1099.
Fill it out as best you can.
The IRS is going to try to match it up with other information they have.
Yep. And you're talking to a guy who's gone through the big, massive payroll audit with the IRS, where they used to do these as randoms, and they picked 50,000 companies. One of our companies was one of them. And yeah, if you don't 1099 them, you could be responsible for the tax. We had out of 700 vendors, we had 2 that we couldn't verify were corporations, and because they had gone out of business. It was a landscaping and a magician.
The magician
who ended up getting second on America's Got Talent. So we're watching him going, you cost me $750. That's all I could say every time I saw him on TV. $750. No, but it was just like, hey, give him a little bit of a check and go away.
And people will often talk about that if you don't file the 1099, the penalty is $50. Well, that's the late filing penalty, which goes up over time. And it could cost you several $100 1099 for not filing them.
Mm-hmm. So it could be a double whammy. And
it could be a double
and the person could have actually paid them too. That's the thing, is like, in our case, we're like, I'm sure they paid, but it doesn't matter. The IRS will double dip. We need those Social Security dollars. All right, so somebody else asked a question, then we'll go back to these. I loaned IRA money to someone who was not able to pay it back. Some of the money was in real estate, but the house has a bank mortgage. What do I do now? Joseph, is it secured, then you would sit there and say, hey, the note's not being paid back, and maybe you're in second position. You sit back and wait for the house to get sold. Banks were, if you haven't heard, the banks were really good about doing this after 2008. They'd let you get rid of that note. You'd go bankrupt. You'd do all these things, but the lien was never removed, and they would wait for you and wait for you and wait for you. And then people would sell their houses 6 years later and end up paying back the bank. So they were like, hey, it's never over till it's over. So if you invested that money or loaned the money from that IRA to somebody, make sure that it's secured. Let's jump back into these. I already did that. The moving expenses, that's an unfortunate answer. And you could thank Congress. They hammered us on the, not just on miscellaneous itemized expenses or deductions on your Schedule A went the way of the dinosaurs. So they're extinct. So they're gone. All those things we used to write off are pretty much gone as individuals. Your employer doesn't reimburse you. You can't write it off. You're a teacher. Well, teacher, you get a $250 amount that you can write off. But you're buying books for your class, unreimbursed expenses, you can't do anything about it. So we usually say set up another company, find a way to generate some income and then offset it so you can actually write some of those things off. All right. How do capital accounts get handled in trusts? Specifically, do they stay with the trust when the beneficial interest is sold?
Well, the corpus of the trust, which is the body of the trust, the assets of the trust, those belong to the trust. So typically anything going on with the corpus, any gains or stuff like that, stays with the trust. The income side of it, if it's a rental property and they're making money, that would go to the beneficiaries.
Yeah. So you actually have a power of appointment over income that is different than a power of appointment over your interest in the trust. So you don't sell the beneficial interest of a trust. Generally, you are a beneficiary.
Mm-hmm.
I suppose you could do that with a land trust if that's all you're holding, in which case everything that you have as a beneficiary, you sell to somebody else, everything's gone. Otherwise, if you have an account inside of a trust, and let's say Jeff is a beneficiary and Jeff passes and the beneficial interest wasn't sold, but it goes to somebody else. So it goes to Toby, the next in line as a beneficiary. Jeff would actually have the ability to give away the income that was in that trust that was for his benefit. But these things are all governed by the trust agreement. So you can take away that right just as easy as you can give that right. I mean, you say there's no power of appointment, period, or there's a limited power. Usually when they're doing a limited power, that's what they're talking about. It's like, hey, you can't appoint, like Jeff can't change who's next in line of the beneficial interest, but he can certainly give away what he earned if he didn't take it. So if there's $100,000 in there and it made $1,000 for Jeff, Jeff could give the $1,000 that it made to somebody else, but he couldn't change who's the next beneficiary in line. It's irrevocable usually. The only time that this is different is if you have a land trust or a personal property trust, where the beneficiary is the one who has the right to control of the actual asset itself. And then what you really have is the trustee owns it in title only. The actual owner is really the beneficiary. And, I always look at child actors. That's essentially what they're doing. The parents are holding the assets for their benefit, but it's still going to be the kids when they hit a certain age. And if that kid sells it, then everything's gone. All right. Keep going. There's a few really good questions that we're going to jump into here too that are out there. How do I write off tuition for our training? So without knowing much more, I'm just going to assume that this is probably a seminar, something where somebody's learning real estate or these things. And if you are already in the field, so let's say that I'm already in real estate. I have a real estate, maybe I'm a realtor and I go to training, I'd write it off through that business. Even if I'm a sole proprietor, I can still write that off. If I'm not in that business, then I would grab it as a startup expense and I would make sure that I'm setting up the company as quickly as possible so that as little of that training occurs pre-incorporation as possible. I really would rather have it be an ordinary necessary business expense. And I want it in that company. And so that's how you write it off. You're really going to want a company, unless as a sole proprietor, that's what you do for a living.
Right.
So there's a really good case that was out there, which illustrated the point. Somebody who didn't set up the entity, the tax court says you're not in business until you're actually doing the activity. So this individual learned to do flipping, spent a lot of money throughout the year, and then in December got his first property. And the court said that's when you started your business. That's when you can start writing things off. So everything he incurred before that, he couldn't. Now, he could have grabbed those as a startup expense in a corp, but by the time he went to tax court, it was more than 3 years later. He's toast. Anything you want to add on that?
No, I was reading a case earlier today where a young lady was a paralegal for a law firm, decided she wanted to become an attorney and took those steps, and the courts turned her down for the deduction because
she wasn't in the field.
She wasn't in the field of practicing law.
Yep. So it has to be for something that benefits you in that business.
Right.
And the example they give, like when I was going through college, I went to Seattle U and I had a whole bunch of Boeing guys. That's where Boeing always sent its executives to get their MBAs. Boeing could write it off because they were bettering the skill set of those executives. I could not write it off because I was not an executive with the company. So the paralegal isn't a lawyer,
right?
So she can't write off the legal classes because it was creating a new profession for her. If a lawyer had gone and taken some classes, they would have been able to write it off.
Correct.
So that's what it is. So it always comes down to that stuff. So anyway, let's go to the next one. My sister and I are partners in our LLC. She is now on disability. So how can she receive profit from the business now? So I assume that you're saying without costing her disability. That's Otherwise, you just keep going. Even if she's disabled, you just receive profit the same way you would otherwise. If because she's disabled, she's not able to participate in the business, she's going to have no material participation. So she's going to get passive income, but it's still ordinary income. If she's receiving disability payments, then I believe you get up to $1,260 a month. And if you go above that, it reduces your disability payment. So you do have to be careful. Now, there's certain types of income, like rents, royalties, dividends, and interest that do not affect Social Security or disability benefits, period. So if you have an LLC and that's the type of income it's making, if it's making dividends or rents or something like that, then you don't have to worry at all. But if it's an active business, like this partnership owns a McDonald's, then you have to worry. Mm-hmm. But again, if it's making a whole bunch of money, then we don't really care. If it's not making, if it's making passive income, then we don't have to care nearly as much. Somebody says, hey, I performed a ROBS transaction. This isn't a question, by the way, that's in the preset questions. This is online. So a ROBS is a rollover as a business startup, which means that they took a 401k and invested in a C Corp that they also own. So they're partnering with their own retirement account. And yes, you can do that. The IRS says you can. The corporation, where I'm the president shareholder, and we're getting an SBA loan for a residential assisted living business. Fantastic. Do I have to pay the 10% penalty for withdrawal? No. Do I have to report the rollover as earned income? No. The 401k owns a piece of that business. And so it just owns stock. I have a real estate license, and I was told it's best not to represent myself as a buyer's agent, as I cannot have personal gain from my own ROBS Corp. I don't know if that's actually the case. I believe that the prohibited transaction was actually avoided because you both became partners in a business. If that corporation in your 401k were to continue to do transactions, it'd be a disqualified party by virtue of you being a shareholder. But once you set this thing up and you set it up correctly, you can't put more money in it, but it certainly can operate. And I don't necessarily think that would be a problem. What I would do is I would email that in so we can get see if there's any cases out there. But that's the type of thing where you want to be a platinum member, because we're going to have to give you a straight up answer. Let's see. Do I have to report my loss the first year of my LLC if I don't have any income?
This is a little bit crazy. If your LLC is a partnership, you technically don't have to file that partnership return if you have no income or expense.
Wouldn't it have a non-payment, a failure to? If it's a partnership, it's going to be a failure to file.
No, a partnership it wouldn't apply to. S corp or corporation, it would.
Really? So, like, if I have a 1065, don't I get penalized if I don't file a tax return?
Only if you were required to file a tax return.
Only if you're required. So if I don't make any money, then I get to say,
yeah. And we've had clients do that they had some setup fees or stuff like that, not a whole lot of money, and have said.
So Jeff would say, if you're a partnership, you could punt. If you're an S corp, you should file.
Absolutely.
And the penalty for not filing on time or not getting an extension or anything like that is $195 a month per.
It's gone up. I think it's $205.
Okay. Jiminy Christmas! It's a lot of money per month for failure to file. So don't not file.
I remember when it was a fraction of that.
Yeah, I remember when it was like really low.
Yeah,
like it was still annoying. But they just here's what they want. They want you to file your return. It's probably better to file your return so you can take your loss. Unless you like. I don't know. If I had a loss in a company, I'm filing that return because I want the loss. Somebody says, I have an LLC but treated as a disregarded entity. Do I lose the protection in a lien situation? No. Yeah. one doesn't have much to do with the other.
Right.
What you have is whether they're going to honor the separateness of the company or of the LLC. And in some states, they'll pierce in a single owner LLC situation. So you tend to want a state that has a statute on it that says, hey, this is how we treat it. But usually they're trying to hold you responsible for the company debts, not vice versa. Let's see. Let's keep going. I've heard it's not worth taking the bonus depreciation. It's actually bonus depreciation unless you plan to purchase yearly. So what they're saying is, hey, if I have this property, it's worth $141,000. Should I take the bonus depreciation? Because it's probably not worth it unless I do this every year and I buy another piece of property every year. So the rule of thumb is whatever the appreciation or the improvement value that's on that property, the non-land value, you could write off about 30% of it if you're doing a good cost segregation. And you'd be able to write that off in year one. So if you have these types of losses, that's considered a passive loss unless you fall under one of the exceptions. Exception one is active participation. You get up to 25,000, and it phases out between 100 and 150,000. So a lot of people make too much to get that 25. If you make less than 100, there you go. You could actually offset 25,000 of your other income. So you're going to get about a 22 cents on the dollar of deduction benefit. The other way to look at this is, hey, I'm making $1,250 a month. How much of that would be taxable to me? So we don't care about paying principal on a loan or anything like that. Usually what I do is I just say $1,250 times 12 divided by 2. So I take 50% of whatever the gross rents are. So if I have $1,250, let's see, I'll do the math here, times 12, that's $15,000 a year of gross rent. So I would say I'm probably making about $7,500. So let's say that I did a cost segregation on a $141,000 property. So let's just say the land is worth 41 and the improvement value is worth 100, just to make this easy. So I have a $30,000 deduction that I could take right now, and I don't qualify as an active participation. The other exception is if I'm a real estate professional, but maybe I say, hey, I just want to offset the income from this property. That's kicking me down $7,500. So I'd have to look and say, what tax bracket am I in? And so that $7,500, how much tax am I paying that every year? So let's say I'm in the 22% tax bracket or thereabouts. We could probably do higher, but I'm just going to go this route. So you're paying about $1,650 a year in taxes. If we did a cost segregation, you're not going to pay that $1,600 and some odd dollars a year for 4 years, at least 4 years. So is it worth doing a cost segregation? It depends. And if the cost segregation is $1,500, yeah, I lost 1 year and I have two. I'm going to gain a little bit for 2 years. And then I'm still going to be writing it off over time. So I always say that there's not a hard and fast rule. It's facts and circumstances. You guys hear me say this probably too much. So it's going to depend on your situation. I always say there's only 3 rules of tax, and that's to calculate and calculate and calculate. So we have to do that. Let's see. Somebody asked a question. I'm trading options, selling puts, selling covered calls. Are there any tax consequences when I buy to close a call or put or roll out of the call or put? Can you explain? So you can do that.
No, go ahead.
All right. So you anytime you do an option, if I buy an option or sell an option, if it expires or if I sell it, that's when it's taxable. So the rest of the time it's not. So if I buy, let's say that I sell an option and I bring in $100, that's not taxable yet.
Right.
Until that position is closed out. So if you buy it to close, that's when it occurs. And now you're going to be looking at the difference between what you got paid and what you had to pay, and you're going to pay tax on that amount. Generally speaking, is short term.
Right, because we're not going to know what the end result is. Or you're going to have to give up your stock, or you're going to have to make good on that put that you sold, or
Mm-hmm. Same thing.
Yep.
So, so that's always the deal. So people, when again, let's say that I'm selling a call, and I'm not a big fan of buying, and like, I'm not an active trader. Some people are really good at it. I'm just not. Timing the market's always going to give me a headache. So I tend to sell calls. If they expire, the amount that I made in the beginning is taxable. If they expire worthless, the amount that I made was taxable. If somebody's calling me out, then the amount that I received for the call is taxable, and the gain that I have on the securities is taxable. So, so it's always that, but it's not taxable until I call it out. So I could bring in money today on something that will not be taxable for over a year. If I sell a leap, I get the money now.
Right.
And I don't have a tax hit for a long time. That's why I like them. Hope that makes sense to you guys. If you're not a trader, you can just ignore everything I said. Let's go back onto a few of these. All right, Jeff. This one looks like fun. What is the proper way to account for expenditures made to improve a warehouse building? Should expenses above a certain amount be capitalized versus expense? Does it depend on the nature of the expense, like HVAC, flooring, lighting, etc.?
Yes, it does make a difference. When I was with another firm, we did a cost segregation of a warehouse construction.
Mm-hmm.
That was a refrigerated warehouse.
Oh, wow.
And due to the nature of it, we were able to write off 80% of the construction costs.
Did you cost seg it, right?
We did cost seg it.
Yeah.
With a larger firm, Big Four firm.
Yeah.
So yeah, and especially on a case like this where it's commercial property, things like HVAC, which are now deductible subject to bonus depreciation,
Yep.
flooring and lighting, you want to be able to break those costs out.
Mm-hmm.
And I would strongly suggest, if this is a considerable renovation or improvement, that you cost seg this.
Yeah, cost segregation just means we take the structure and we separate it from all the components. And the components have a shorter useful life. So, for example, I always use carpet just because carpet usually sucks after a year.
Mm-hmm.
If I have carpet, it's not going to last 39 years in a commercial building. It's going to last maybe 5. So when you cost seg it, you can use the typical life expectancy of carpet, which might be 5 years, and you can write it off either over 5 years or choose to bonus depreciate it and write it off all this year. So when you're doing a warehouse building, which, by the way, I own a couple of those, and I do have some, I know what it means to have the refrigerated stuff. Holy cow, Jeff, that's some, it's not easy. We have a 3rd floor of one of our warehouses that's all refrigerated. There's a lot of equipment and things like that go into it that if you don't do anything and they're just attached there, you're going to write it off over a really long period of time as opposed to just writing it off now. So the first thing you do is do what Jeff just said, and that's make sure that you are cost segging. The other thing you can do, depending on what type, depending on what type of warehouse this is, if it's a big, huge one, you can kind of ignore this. But if it's a little one, you have a safe harbor of any expense that's below $2,500. You can choose to make that an expense. So even if it's an improvement, it doesn't matter. You can choose to elect to treat it as an expense. So you put $2,000 in, and you're putting it into some an electric system or something that's going to benefit the building. You could choose to expense it.
Yeah, and you got to be cautious. And the reason you want to do a cost seg is not only get the expense, but in a commercial building, there's a lot of property that you wouldn't consider to be equipment or separate, whether it's like truck docks or doors, things of that nature that could be broken out into much shorter lives than that horrible 39-year life.
39, that's just crazy. That's the structure itself. All right, here's speaking of crazy, here's the one that I looked at this and go, how the heck did this get over to me? Usually I have my staff pulling stuff out, making sure that the very specific stuff is rolled out into platinum or something. And like the little zipper ones that we can just hit, we can do as part of the show because it's, they're a lot of fun. They're little ones that gives us a chance to give the options. But here's one that was very interesting. I'm selling a car wash and doing a 1031 exchange. So let's just right out the gate. You can't 1031 exchange a car wash. You can 1031 exchange the real estate that has a car wash business operating on it, but you can't 1031 exchange a car wash anymore, period.
Unfortunately, with a car wash, most of what you would consider real building is equipment.
Right. Which is also another issue. So then we say, all right, so we're selling this thing, and let's assume that we're selling a business. So, hey, it makes $5,000 a month. So we're gonna sell it for $30,000, and then the real estate we're gonna sell for $300,000 or something like that.
Mm-hmm.
Can I roll the money into a real estate fund like an opportunity zone? Yes, you can. So even if my car wash is $60,000 and there's $300,000, I could choose to take the 60 and put it in an opportunity zone and defer that tax, because when I do it in an opportunity zone, there's different components of it. You have deferral of the original amount, you have a step up in basis on that original amount, and then you have an additional step up in basis in the total investment in year 10. Or anything over, if you own it 10 years, at any time you choose to, you could step it up to fair market value. So let's just assume that it's again my scenario where I sell the car wash for 60 and the real estate for 300. I could exchange the real estate and push my basis on my first property into the new property, and I don't have to pay any tax. I don't have to worry about it at all. I take the 60 and put it into a real estate fund in an opportunity zone, and I meet all the other fun stuff of what that is doing. And I will be paying tax on that 60,000 subject to the opportunity zone rules, which means in 6 years, it'll be a taxable event, and I will pay tax on that 60,000 with one little step up. At year 5, I get a 10% step up. So I'm going to pay tax, follow my logic here, on 90% of that 60 as whatever it was. If it's 1031, if it was long-term capital gains, I'm going to pay it at long-term capital gains rates. So I have lots of planning opportunities there, but I'm going to pay tax on it. Then let's say we keep it in there, and this is where it gets interesting. In 10 years, because I deferred portion of that income, whatever I bought in that opportunity zone with that 60, and I could have leveraged it up, I could have taken loans out. In 10 years, I don't have to pay tax on any of that gain ever again. So if that thing's worth $1 million, fantastic. If in another 10 years it's worth $2 million, I don't have to pay any tax. If it hits, I forget the exact year, is it 2047, I believe. If we hit 2047, then I will step up my basis to the fair market value on that date. I don't have to sell it. I would just have a new basis of whatever the fair market value is. So if I sit on this thing for close to 20 years or more than 20 years and it goes way up in value, I don't have to sell it to get my step up. And then is it the same basis if I donate the property to a nonprofit? So it's again, same thing. I have a car wash at 60 and I have my real estate at 300 and I give it to a nonprofit. The nonprofit's not going to take the for-profit business, first off, because it's going to be subject to unrelated business income tax. But the real estate I would take, and you get a donation based on its value. It's $300,000, so it doesn't matter about basis. You get a donation on its fair market value, assuming you owned it for more than a year. If you didn't own it for more than a year, then it would be whatever your basis. So I'd assume it'd be pretty close to the same thing. Isn't that fun?
That is fun.
I always look at those and I'm always like, hey, this is really cool. If you take the whole amount, so let's say that we don't even have the real estate, but we just have the car wash and it's worth $500,000. Yeah, you could dump that right into an opportunity zone fund within 180 days. And then you have another 180 days to deploy it into opportunity zone property. And so, yeah, you put it into an apartment building. You have to meet the rules, which means you have to improve the value of that apartment building. You have to double the improvement value. You have to put in at least as much as what the value of the apartment building itself, not the land, just the building itself. You deploy that within 31 months, boom, you get, now you qualify. But you will be paying tax in 6 years on that.
Yeah, and one thing that's important when you're doing a sale of any business is to really give a lot of thought to what you're selling and for how much. We'll have people come and say, I sold my car wash for $100,000. And we're like, are you sure? Because I think you may have sold the operations, you may have sold the land, you may have sold the building and equipment, and you got to decide how much all that costs. And then you have to come to an agreement with the buyer as for those cost allocations. And some of those will benefit you, and some will benefit the sales.
That's part of it. That's why you always want to have your accountant involved if you're buying or selling a business, because it's not what you make, it's what you keep. And if you're selling an asset that's going to be ordinary income to you, you're going to be pretty upset, as opposed to selling the underlying business itself, which may be long-term capital gains, or you do an installment sale and you start spreading it out over many years. There's all sorts of things you can do. A bunch of questions online. How do you delay taxes for 6 years? That's the opportunity zone. And that's if you invest in certain areas, and it has to be capital gains. And then somebody says, hey, it's $50 first 90 days, $100 thereafter for the 1099.
And then willful is like $200.
Okay.
1099.
And then somebody is saying, we'll take a look at that question. What happens? So this is going back to one of our earlier questions about the first position, and you're in second position with the IRA, and somebody says, what do you do if you force the sale? Like what happens? Well, anybody who has a lien can force the sale. So if I have a lien on your property in your real estate, I could say, all right, let's sell it. And then the way it works is at the auction, you get so much money, the first gets paid first, and then the second gets paid. So the first will usually go bid whatever it is owed on the property, because that's what it gets no matter what. So it's not coming out of pocket, it gets the property. The second will probably want to be there bidding up to whatever the total between the first and the second equals. Because it wouldn't want to pay for the first, it's just going to give all the money to the first, and now the second doesn't get anything, and it's done. It's cooked. So it doesn't have any more security. So usually when you go in there as a second, you better be prepared to pay up to the total amount that the first is owed plus the second, plus whatever you're owed. That goes for if you're in third position too. When doing a loan on real estate from an IRA, what is the best instrument to secure it? Deed of trust, or just basically a mortgage. Can you write off MBA tuition? It depends on the business. Let's say that you're a president of your own S Corp and it's going to benefit your business, an executive MBA, can you write that off? I would say, yeah, absolutely. So you could certainly do that. EMBAs is what you're talking about, and that's why they're actually pretty popular, because businesses can go out there and, you're getting trained and you're getting more valuable at the same time.
Yeah, that can fall under what they call the working condition fringe benefit, that you need to increase your expertise with that MBA.
Yep.
So that the company more or less forces you to pursue that.
Yeah,
and they can reimburse you.
And if it's you and your company, then it's just what could a other company have forced you to do it? Yeah. So it's just, again, if a third party could have done it, so can you.
Right.
As a partner, the LLC can't pay a silent partner a shareholder dividend. No, so a shareholder dividend is a corporate deal. So if you have an LLC that has a silent partner, I guess if you have a silent shareholder, you could pay a dividend. So like if it's a C Corp, you have a dividend. If you have an S Corp, it's a distribution, and it's going to be taxed as your ordinary rate. And the question is whether you're materially participating in the business. If it's a partnership, it's just a distribution.
Correct.
And if it's a sole proprietor, then it's nothing. So yeah, you threw some terms together there, Susan, but this is why it's fun to talk, because we can actually walk you through that. Are HSAs a good vehicle to reduce your tax burden, grow money, and anything else? Yeah, absolutely. I think so. You have to have a high deductible plan. I mean, I forget the limits, but it's like, I want to say like for a family, it's not huge, but.
Right. I don't remember what the limits are, but it's a good way to tuck money away for a medical emergency that's deductible in the current year.
Mm-hmm. All right. So home office question. Is it better for my C Corp to deduct the expenses of its office in my home or to reimburse me? Reimburse you, Carol.
Absolutely.
Reimburse you without any hesitation. If you have a C Corp, you want an accountable plan, you get reimbursed. You don't have to report that anywhere, which is going to become relevant as we get to another question. I have to figure out where it is. Let's see. I don't know how far we're in. I know we're over an hour, and yes, people always yell at me saying I'm going over. That's why I don't tell you when we're going to end, because I like to be annoying. All right, we are thinking of selling our owner-occupied property to a C Corp using a contract for deed to get the $500,000 capital gain tax-free. How I structure the tax plan to get the max tax savings benefit. Jeff, what do you think?
Well, by owner-occupied, I'm assuming they mean primary residence.
Yep.
So not knowing for sure what they're going to do with the house in the C Corp, I probably would prefer to put it in an S Corp if I'm going to make a rental property.
Yeah.
One thing I think that's important here is it needs to be an arm's length transaction.
Mm-hmm.
You can't just arbitrarily decide how much the sale price is going to be, especially between related parties.
Yep.
So I would suggest using not an assessor, an appraiser.
Mm-hmm.
And usually if you tell them why you're looking for an appraisal, they'll work with you too.
You could do a broker value opinion.
Could you?
Yeah, I think you could do, like, the appraisal is the bazooka, and it depends on how hard you're pushing it.
Okay.
Like, if I am sitting here, and here's the rule, by the way, they're talking about the $500,000. That's for married couples selling their primary residence that they've lived in 2 of the last 5 years. That's section 121 of the Internal Revenue Code. So you're always going to hear them say the home gain exclusion or something like that. For a single person, it's $250,000. So if you bought a house for $100,000 and it's now worth $300,000, you could avoid $200,000 of capital gains if you sell it. And so that's all this is they have a house that's gone up in value, and you better be leaving the house. Like, I would not do this if you're going to be staying in the house. What most people do is they say, I'm going to turn my house into a rental, and they leave a lot of money on the table by doing that if they don't take advantage of 121. So let's say you bought a house for $250,000, it's worth $750,000, you're going to rent it, it's going to make $5,000 a month or something. And you just convert your house to a rental. The amount that you can depreciate is based on the $250,000. It's not what it's worth unless you sell it. And now you have a step up in basis to the new entity. And so under those circumstances, I bought the house for $250,000, it's worth $750,000. I can reset my basis to $750,000 if I sell it to another buyer. And that other buyer can be an S Corp or a C Corp, an LLC taxed as an S or a C Corp. I wouldn't do it as a C Corp. Generally speaking, I'm going to do it as an S Corp. The reason being is because if I sell the property, I want to get long-term capital gains. In C Corp, I'm never going to have capital gains ever again. It's just going to be income. And so I could get hurt there. So I sell it to the S Corp at $750 or $750,000. I now get to use up my entire $500,000 of capital gains exclusion. I tell the S Corp to please pay me over a long period of time. So I'm going to do an installment sale. And then I'm going to elect out of installment sale treatment in year 1 and take the entire amount as capital gains to me, even though it hasn't paid me back yet.
Right.
Now, what I just did is I'm going to have a tax-free income stream coming in for a long period of time as it's paying me back. And I now have a $750,000 basis in a piece of property, so I can depreciate it at the $750,000. Right. And that is absolutely 100% okay to do. Good tax practitioners understand it. And then to make it even more fun, you could actually do that. And technically, if you have even more gain, you could 1031 it to something too. Gets fun. So you're looking at me like I'm from.
No, it's. I agree.
We're getting late into this, right? Right. I am president of a C corporation. Can I deduct long-term care premiums for me and officers of the corporations? What say you, Jeff?
Yeah, I mean, the corporation has two choices. They can either reimburse you through your 105 plan, or they can pay those long-term care premiums directly.
Yeah.
Either way, they get to deduct the full amount. There's no limitations like there are on your personal return or self-employed.
Yep. You just can't discriminate. So you say yourself and officers of your corp, yeah, but just make sure that if you have the rank and file, that they're also allowed to participate.
No, surprisingly enough, I think this is the one area they can discriminate in.
On long-term care
On
premium?
long-term care premium.
I don't think you can do it on a reimbursement.
Oh, probably not.
Right. So if maybe the company purchased it as an executive compensation plan, then you
That
could
makes more
possibly
sense.
do it. Yeah. So, but if I'm reimbursing for long-term care, and I'm just going to tell you guys, it's going to be really tough to get long-term care.
Yeah.
What you're probably going to end up doing is getting life insurance with a rider on it for long-term care, because most of the insurance companies have been burned to death under the extreme cost of long-term care. Like when I looked at the data the last time, over a third of long-term care policies had claims made against them. And just to give you an idea, put that in perspective, about 2% of life insurance contracts term have claims made, and about 6% of car and home insurance and all these are all in the single digits. So this sticks out like a thumb. The two that stick out like a sore thumb are long-term care and index universal life, whole life policies. They have a large amount of double-digit claims made against them. And that's because they stick around for a long time and they have some inherent value. All right. We purchased a house in April of 2019 and lived in it for 3 months. After moving out in July, the house was available for rent. We then decided to undertake major renovation addition without renting it. Do we add all the expenses to basis, or can we do cost segregation to keep our income down?
I think you could do the cost segregation to keep your 2019 income down.
Mm-hmm.
My only concern was it looks like it was available for rent and then it wasn't. So my concern was IRS coming back saying, no, this was never available for rent.
Yeah, I've dug into this once or twice before. And here's how it always works. There's a whole bunch of different rules. And so I don't mean to get, it's always kind of a complicated answer, right?
Mm-hmm.
So you bought the house in April and it was personal property. You don't get anything for, except adding to basis when you improve the property, and then when you sell it is when you get the tax benefit. If I make it into a rental property, then the day that I moved it into a rental property, which is when I make it available and I'm showing that I made it available or I rent it, now it's the value, it's the fair market value or whatever I paid for it, whichever is less. So within 3 months, it's going to be the same.
Right.
Like, I don't think you're going to have any issue there. So now you have the ability to start depreciating it once you make it available for rent. Now, there are like 7 or 8 factors that the IRS looks at when you don't actually have rents coming in. Like the receipt of rent is a pretty easy one, right? But that's only one factor. They look and say, where were you living? What was your real intent? Like, did you have 2 other houses and you were making this one available to rent just so you could depreciate it? All this stuff they look at. How much advertising did you use? Professionals? I've seen them where they actually denied it, and this was really horrible. The one case that I remember sticking out like a sore thumb was they had a house and the daughter died, and the parents were so distraught that they couldn't live in the house anymore. And they put it up for rent, but they didn't really advertise it, and it was kind of like they only wanted the best renters, so nobody ended up renting it, though it was available for rent. And then like 2 years later, they sold it, and they wanted to, and they lost a bunch of money when they sold it. It was in the down market, and they wanted to take that as an ordinary loss. And if you know what happens on your house, if your personal residence goes down in value, you get no loss. It's personal property.
Right.
So the IRS contested it, the dogs that they are. No offense to the IRS, but that's pretty bad. These guys moved out of a house because they couldn't live in it because their kid died. And you're going to like mess with them over the loss. And they just said they didn't try hard enough to rent it. And the IRS won on it. So it's like, you got to show that you actually tried to make it in. If you make it into a rental now and you make sure that you rent it and you show that I tried to rent it, but we couldn't get enough because the house was too old-fashioned, dilapidated, fill in the blank, that the realtor said, you need to fix it up. Get that email, put it in your file. Get that writing, put it in your file, show that you made it available and that it wasn't right for the market, so you fixed it up. Then yes, it can push your 2019 income down. That was a long one. Now here's the other thing. Your 2019 income, it can only push down your passive income unless you're a real estate professional or unless you're an active participant. Otherwise, those are passive losses that aren't going to help you out at all. You'd just be carrying them forward. So after all that, you guys always trigger like 3 or 4 issues in these little questions, and they always seem so innocuous, but they trigger like so much stuff. That's why you got to deal with people that do real estate. And it's great for these types of programs because it's so wild. Like people out there with tax that like this really like taxes. This is like tax crack. This is your good stuff. All right. As a new C Corp in which I am the sole officer, if I cannot afford to pay a reasonable salary, can I submit items to the C Corp for reimbursement? If I do, wouldn't that draw a red flag from the IRS since I'm drawing compensation in an indirect way?
Well, when we talk about reasonable salary, the only thing that really applies to is the S corporation, not the C corporation.
Mm-hmm.
The C corporation has another little tricksy thing where the IRS doesn't want you retaining too much of your earnings, your profits in the company.
Unless you're like Apple or Microsoft or any other company that keeps billions of dollars on its balance sheet.
And that usually isn't a worry. Mm-hmm. Most people have a reason for keeping the money in. They're planning on buying additional investments or so forth.
Mm-hmm.
So even if you're not drawing a salary, you still want to submit items to the C Corp for reimbursement.
Mm-hmm.
That's one of our big reasons for setting up C Corps. They may be managing other things, but the C Corp has some opportunities in it that other entity types don't have.
Yep. And yes, it can reimburse you. And here's the thing. When you look at compensation under the Internal Revenue Code, it includes wages and fringe benefits. A reimbursement is a fringe benefit that is taxable unless there's a code provision that says it is not. So we look at the code and it says it's not. There's actually, 26, is it CFR? The regulations 1.62-3, if I'm not mistaken, allows you to do a reimbursement plan, and it's not included in the employee's wages. It's not subject to self-employment or withholding or employment taxes. What this means in English is there is no red flag because the C Corp just shows as an expense and you don't report it on your return. So it's literally invisible to the IRS. So it's one of the best things you can have. So yeah, if you submit the items to a C Corp for reimbursement, don't worry for 2 seconds.
Right.
That reimbursement's actually compensation, but it's non-reported or taxable compensation. The other areas where you see that pop in is when you have 280A is a great example. If it's reimbursing cell phones and all that fun stuff, that's all under that category. So we really have 2. And then, by the way, you could also reimburse yourself for things like an administrative office in your home. There's all sorts of ways to get money out. And even if it creates a loss for the corp, it doesn't matter. You just carry it forward. If it's C Corp, S Corp, it could create a loss for you. And then, as Jeff said, you have to always worry about how much money you're taking out. Technically, you don't have to take a salary out of an S Corp. You only have to take a salary out of an S Corp if you're taking distributions out of the S Corp. And then the rule of thumb is at least a third of that distribution should be in the form of salary. So if you're taking no distributions, you don't have to worry about it. It can reimburse you all day long and even create a loss. All right, I know we're way, way, way behind. I don't even know how many more questions we have, but let's go to this one. Do you have to use the accrual method for books when you start dealing with loans for the company? Is there an advantage or disadvantage to using cash or accrual accounting?
Most of our clients, and we recommend that they use the cash method. And the big advantage behind the cash method is you can control your profitability more with it.
Yeah. So accrual just means that if I'm due money, I report it as though I received it. And if I owe somebody money, I report it as an expense, even though I haven't paid it.
So large companies, your Apple, they have to use accrual method.
Anything over 5 million, I think you're required to use accrual. So,
yeah, even for home construction, I think they can go up to 10 million in revenue and still go on cash basis. And
there's a few little exceptions, but
right.
Eventually you get big enough, you're forced to use accrual.
Now, the one thing is with cash and accrual, you're either cash basis or accrual basis. You can't do this hybrid basis where I'm going to treat this under cash and I'm going to treat some other item as accrual.
Mm-hmm.
The one exception is the pension contribution.
Yeah. You can treat that as cash even though you're accrual.
Right.
Yep. See, we just love this stuff. The difference, so in a nutshell, if I pay something as a cash basis taxpayer, that's when I can write it off.
Yeah, that's a good point.
If I'm an accrual-based taxpayer, then the day that I owe it is the day that I can write it off, even if I haven't paid it.
Right.
And and you're required to be accrual at some point, depending on the size of your company. They're going to eventually push you over because, as Jeff said, that's more accurate.
And the way you can control income is, say it's the end of December, you can wait till January to send an invoice to somebody who may owe you money. And that's perfectly fine. It moves it to the next year. You just can't, once you've received that cash, you can't hold on to their check and not cash until January.
Yep. Now, here, somebody just asked a really good question. Actually, on this issue, we're just going to answer these two. If a payable runs higher than a receivable, would that suggest using accrual method?
Well, typically you don't have payables or receivables on cash method. If you're working with QuickBooks will convert those receivables and payables if you're doing it right. And I don't always do it right, but it will convert it to cash method, and you'll see those receivables and payables disappear.
Yep, and they'll be listed as something else,
right,
due from, stuff like that. It'll note it, but it won't be. Yeah. So the answer to your question, John, is if you have greater receivables than your payables are higher than your receivables, and you need the tax relief, then yes, it would make sense to go accrual if you have that option. Can you change from one or the other? No, I think you have to. I think it's annual. You can do a change of accounting method.
Correct.
Right? But once you do it, then do you have to? Are you stuck with it for more than a year? Or could you do it back?
I'm not sure about that, but when you do change those methods, you have to account for any differences in the methods going backwards.
Yep. Somebody says, does the officer have to pay the tax on the premium? And I think it was on the long-term care. No, if it's part of a 105 plan like Jeff was talking about, that's a health reimbursement plan, then it's non-taxable to the officer. I'm using my wife's corporate health insurance. Are the premiums, deductibles, and co-pays expenses? The C Corp, basically, can the C Corp reimburse me for those? Yes, it can. C Corp can absolutely reimburse you anything that came out of pocket. And then somebody says, what about LLCs for those types of reimbursements? An LLC is not a tax type. So if that LLC is taxed as an S Corp or a C Corp, yes, you can. Technically, you could even do it as a partnership, depending on whether you're a material participant in it. So it depends on what that business is doing. If it's real estate, then no. If it's a traditional business, then yeah, probably. Guys, there's a whole bunch of other questions out there. Somebody says, all right, I'll have to take a look at it. I know we're way late, so I'm just going to bust through these last few questions. How do we get so long? If my corporation has a promissory note to myself, but interest is less than $600, do I have to give myself a 1099? I still claim interest on my personal taxes, correct?
Yes. So the 1099, that would be a 1099 INT, and the trigger is not $600, it's $10. So if you pay yourself interest of more than $10, you have to issue a 1099 INT.
So if you have more than $10 of interest, then yes. If it's more than de minimis, so the de minimis is $10,000. So if you have a loan with more than $10,000 to your company, then it's required to pay you some sort of interest.
Correct.
And then if it's more than $10, then you're going to have to do a 1099.
And the important thing is the last thing he says about, I still claim the interest on my personal taxes, correct.
Yeah.
Whether you get a 1099 or not, you're supposed to.
If it's paid to you.
If it's paid to you, you're supposed to report.
Now, the corporation gives you a 1099 if it's paying you more than $600. But if it's the other way around, then you don't have to give a corporation a 1099.
Correct.
So just so you know. And then somebody says, hey, I thought an S corp cannot reimburse medical reimbursements. It can. You have to report it as wages. Technically, you're right. Like when we do a medical reimbursement plan, I'm going to use a C corp. But an S corp can. But if you're greater than 2% shareholder, you have to include it as wages.
That's the health insurance. Other medical reimbursements, they can't claim at all.
Yeah. So it gets stinky. It's just wages.
Right. So health insurance, they can reimburse and report it on your W-2. Other medical out-of-pocket expenses, they can't do at all.
Well, if they reimburse you, it's wages, right? It's going to be considered compensation. It's not that it can't give it to you. It's that if it pays for something to you and it can't call it a reimbursement.
Yeah, there's really no benefit to it because it doesn't get included in that self-employed health insurance.
Right. It's just going to be taxable. So, I mean, you're right. If this is yours, you're going to use a C corp. So I'll just make it real simple.
That's a good answer.
Yeah. Here we go. And then we got to get off this line. If someone is in a memory care facility, locked down 24/7, is that tax deductible? So assume if you're paying for it, and Jeff, you know this one right off the top of your head.
Yeah, I mean, what is tax deductible is the medical or skilled care portion of that. And these facilities are usually good. When you sign into them, they'll give you a piece of paper that tells you how much of your expense is going to be deductible. So with like an assisted living facility, it's going to be a much lower percentage of your total cost. Mm-hmm. But with a skilled care facility, it's going to be, which this probably is with a 24/7 lockdown, it's probably going to be the majority of it, 80% or more.
That you're going to be able to reimburse.
That you're going to be able to.
And you would write that off, even if you did this. Like, so if you're somebody who's already gone through this and been going through this, then it's a medical expense.
Right.
And so that would still go on your Schedule A. So it'd just be any amount over 7.5% of your adjusted gross income. So a lot of older folks, maybe in the lower income brackets, just because their only income they're being force fed is the required minimum distributions, maybe some Social Security. This will lower that. This will actually reduce it. And a lot of people don't realize that you can actually write a lot of this stuff off. If you have a C corp, it can actually reimburse you. So if you have somebody and they're dependent, then you could do it. And there is no limit on the medical reimbursement amount. In fact, under Affordable Care Act, you had to remove all limits. You couldn't stick a limit on it. We used to put like $10,000 in there so we didn't have anybody get caught accidentally. Somebody just said, here's one last thing. I need help with my tax plan for Social Security. Just reach out to us, Joseph. I'll give you guys the email here in a second. Somebody just said, hey, I paid legal fees and I didn't think the 1099 was necessary to the firm. I realized it was, and I requested the W-9, and they said, nope, we're not going to do it because we've already paid our taxes, which means they didn't report it, the little dogs. Should I 1099 them even now, even though I'm late? Yes. Even if you don't have their tax ID, use their address and everything else. I'll just make that easy for you. All right, guys, you're going to hear this one more time from me. Go support our veterans, oneveteranfoundation.org, 22 on average. 600 veterans a month commit suicide. We got to stop this, and nobody else is doing anything about it. This one particular group does service animals for veterans, but by all means, go find your own if you don't want to use ones that we like. I just happen to know that the suicide rate goes to 0 when you have a service dog with a veteran member. Always feel free to go to our AndersonAdvisors.com podcast and go listen to some of the old Tax Tuesdays. Our replays, if you're a platinum member, you're going to find them in our portal. You'll be able to find them. And then we always send out here. For those of you guys who asked a bunch of questions, Marie says, hey, does cost seg benefit on a single family? I know we went over that. Yes, quite often it does. You calculate things. You figure out what it actually looks. By the way, for cost segregation, I have a guy who will do all the analysis for free and give you the numbers, and we'll work with you to make sure that you know whether it's a good deal or not. Speaking of the podcast, go to iTunes and you can see all these things that we throw up there. I put all my Tax Tuesdays in there. Me and Jeff, we always put our stuff up there. We're pretty much open books. Jeff's CPA, I'm a tax lawyer, but all we do is we sit here and play with taxes all the time. And then you can go to Google Play. You can always follow us on social media. This is always, oh, somebody says there's a group in Texas. Yep, absolutely. Yeah, there's more than enough. So you can always take a look at those, and by all means, feel free to join us on social media and interact. A bunch of you guys are responding to the veteran stuff. And yeah, it's a huge issue, and I hope that we knock it out. I know we're talking about taxes, but life's about more than just money. And a lot of these people don't feel the need to live, and they need to know that we're not just abandoning them. They've gone through some pretty heavy stuff quite often that puts them in that situation. We had somebody here who was a minister's assistant, or chaplain's assistant, I should say it right, and was in a Humvee that had that got blown up, and everybody else passed, and he managed to survive, and he even had a bullet in his helmet when it was all said and done. And here's a guy that's like a really, great guy. Years later, and you have a thunderstorm, and his eyes get as big as saucers. So this is not something where they sit there and again, you could be the toughest dude, the toughest chica out there, and what goes on between that 8 inches between your ears can be pretty devastating. So anyway, questions, Tax Tuesday at AndersonAdvisors.com, or visit us at AndersonAdvisors.com. But if you have questions, just shoot it into Tax Tuesday. We get it. We push it around, and appreciate you guys. Appreciate all the questions. If I didn't get to your question, I'm so sorry. I know there's a bunch sitting in there. I'll see if we can't pull them down and get answers to you, even though you didn't get them live. We'll go through them. We get about 200. I think we went well over 200 questions tonight. So we'll make sure that we get you some answers, and maybe we'll grab a few of them. There's a bunch of good ones. Appreciate you guys. Until next time, this is Toby and
Jeff.
And have a great rest of Super Tax Tuesday.